There's been a lot of volatility in the stock market this September, and that's not a big surprise because September is historically the weakest month of the year for the market. Now, with the Fed decision on interest rates coming up next week, are we looking at a crash or a rally based on what the Fed does? Well, I'm going to show you a simple technique that will help you predict not only what will happen with the market this week, but something that you can use in your own analysis going forward. I'm also going to provide my analysis of the stock market, commodity markets, currency markets, and bond markets using my bearish, bullish, neutral ratings for those groups. And then finally, at the end of the video, I'll show you a short-term trade, a day trade, that earned 5 times its risk in just half an hour. All right, let's get into this analysis on the Fed and how that's going to move the markets. And if you've been watching my videos for a while, you'll know that I've been pretty good at predicting the swings in the market or in big stocks like Nvidia. And it all comes down to using some simple techniques where if you can draw a straight line with a ruler, you can understand what's likely to happen. Now, as traders and investors, we are never going to be able to do what will always happen. We have to trade probability. So I'm going to give you an outline of what to do to predict what is likely to happen. But let's set the stage first for what's coming up. So the Fed is due to make a decision on U.S. interest rates on Wednesday with their Federal Open Market Committee meeting. And the expectation is that there will be a quarter-point drop. There's a 55% chance of that. But there's also a 45% chance that the Fed will lower rates by half a point. Now, what's motivated that is the weakness in some of the economic numbers that we've seen. Jobs numbers haven't been great. Some of the consumer spending numbers haven't been great. And that makes investors a little concerned that there may be a recession coming. So we've got this balancing situation going on where the market expects the Fed to lower rates. That's good for stocks. But if they don't lower them enough, then the concern is maybe we could go into an economic slowdown, a recession. I don't know what's going to happen. We can look at what the bond market predicts, but what's most important actually is to look at the chart of major indexes like the S&P 500 and the NASDAQ 100 and use those to predict where the turning points are likely to happen. And we can do that with some basic charting rules. So let's jump into, first of all, the chart of the S&P 500 here. And I'm going to draw some lines across the line of resistance, which is at the highs, and draw a line across the bottoms, which shows that the bottoms are rising. So what does that mean? When you have rising bottoms on a chart, it means optimism. This horizontal ceiling price here represents resistance. Now, this chart that I've shown you is a weekly chart. And if price rallies into resistance, as we see it has, it's come up to that ceiling price, it is highly likely that the market will move lower from that level. So given that we've had about a week's worth of gains here moving up into resistance, it's likely that price will pull back, but not that far, because the trend line here will give it some support. So essentially what I see happening this past week is the market is pricing in a reduction in interest rates. The hope is half a point, but the sure thing is a quarter point. And I think if we don't see a half a point drop, we might pull back a little more sharply, but ultimately we have this rising bottom line here that's going to provide support for stocks. And because the bottoms are rising, the bias is to the upside, and so we should see, maybe not next week, but in the weeks ahead, a breakout of that trading range. Because here's the other important thing about the market and seasonality. The market tends to do its best from October until May. Now sometimes it's November, sometimes it goes until June, but it's kind of quite a reliable indicator that the market does well from October until May. We've had a quiet summer, we've had quite a bit of volatility in September, but now expect that the buyers are going to start to come back, and we could see that breakout as the market prices in a cycle of lowering interest rates. Now let's take a look at a chart of the NASDAQ 100. And it's a little different here because here we've got falling tops and rising bottoms. Now, if rising bottoms mean optimism, well then falling tops must mean pessimism. And when you have both, you essentially have a neutral pattern. But it's actually not neutral because the trend into the pennant, this is called a pennant pattern, the trend into the pennant really predicts what the trend out of the pennant will be. So we've got an upward trend into this pattern of compressing volatility. I think that's very likely we'll see a pullback early next week, but not a significant one because we're going to hit that bottom range at the bottom of that pennant pattern right here. So we'll come down into this range. We should then bounce off of it, and I think more than likely we will see it break out in the weeks ahead. Again, using that seasonality of the market. So crash or rally, probably a short-term little pullback, but quite minor, and then ultimately more strength in the weeks ahead and really the months ahead as we go into that strong season for stocks. All right, now let's do my normal market analysis. I always like to do a look at the S&P 500 on the weekly time frame as well as the very short-term time frame. So here we have the weekly chart of the S&P 500. I can draw a line across those bottoms. It's trending up. Over the past 2 months, we've essentially been quite volatile and sideways, but the trend is still positive. We just need to break out through that range. I think that should happen in the next couple of weeks. Looking at the very short-term chart, the 120-minute, 2-hour chart, you can see that we fell lower, we've risen back up. We're probably going to go sideways here, maybe pull back a little bit, but then look for that breakout. So watch for a break through that ceiling price. If we go back to the NASDAQ chart and again look at it on the weekly time frame first, not as healthy as the S&P chart, but it did hold the trend line. Look at how reliable that is. It's hit it once, twice, 3, now 4 times, almost a 5th time there. And so we should break out of this pennant pattern in the weeks ahead, but next week wouldn't surprise me if we get a little bit of volatility to the downside. Let's move along to the Russell 2000, which represents small cap stocks. IWM is the symbol. And here we have a pennant pattern building as well. The trend into the pennant is up. And so in the weeks ahead, it should move up. And again, a lot of that will be motivated by the expectation for lowering interest rates. Here is the pullback that we had on the intraday chart, and that was broken midweek. And since that time rallied. Now coming up to resistance where it will get stuck, probably pull back, build a rising bottom, and then hopefully we'll see it break out. Canadian market is a little stronger than the US markets. Here is the XIU, which is the TSX 60. You can see the trend is up. We are in an upward sloping channel. When it gets to the top of the channel, it probably pulls back and has some profit taking, but the outlook here is relatively positive. If we look at the 1-month time frame, you can see that unlike the US markets, which got stuck at resistance, the Canadian market was able to break out. And the reason for that largely is strength in gold and then of course the banks in Canada, because the Canadian banks have, or the Canadian central bank has been lowering interest rates for a while now. It's now had 3 rate cuts, and that is helping the Canadian market start to move higher. It's sort of a test case for the US market. We've seen the Canadian market lower rates, and its stock market has been going up since that cycle started. The US is lagging in that regard. It has not lowered rates yet. And so what we're seeing then is what would probably happen will be that the US market will move up as interest rates start to come down in the US. Here is the gold chart, and you can see the trend is up. This is the weekly time frame. Gold had a good week this week. If we look at the intraday chart here, you can see the breakout on Thursday and continuing higher. Let's take a look at the oil chart. Oil has really lagged, and it is fallen to support, made a little bounce. I think oil probably moves up, but it's really not a great place. You can see the sentiment stock score is 30, so it's pretty low. That means pessimism in place. And if we look at the 1-month time frame, you can see that the trend is generally down. We did break the downward trend on Thursday, and if we can build some rising bottoms and then start to move up off of a rising bottom, you might see oil start to recover. But for now, I think generally it's a market to avoid unless you're a very short-term trader where you can sort of bottom fish some of those moves. All right, how about the US dollar? UUP is the symbol. And whoops, that's not the right one. UUP. And let's take a look at the 1 month time frame. We have rising bottoms in the very short term, building towards that resistance level. So that's the trend was down into that. So we'll give this kind of a neutral rating. The 3-year chart really stuck in this sideways range, so neutral there as well. Now, Bitcoin had been very volatile in recent months. And if we look at the 1 month time frame, you can see that it started to stabilize this week. So I'm now basically seeing a neutral chart where last week I was a little bit more concerned about it. And the 3-year chart is still relatively bearish because look at how you've got falling tops on the chart. So the sellers are still in control. It's not really bad, but it certainly isn't a positive chart. Now the final chart that we're going to look at this week is TLT, which of course is the bond market in the US. And this is where I see the best opportunity because we broke the downward trend. We're building rising bottoms and likely to break out. That looks a little more clear when we look at the short-term chart. If you look at a 6-month daily chart, you can see how we are trending up. We broke out of a pennant. There's a pennant pattern there. We broke out, and that should lead to higher prices. And that really sets up for one of the places where I see opportunity in the market right now. Interest rate sensitive things. So real estate investment trusts, banks, things that have good yields, they are showing strength where really they were ignored for so long because we had weak markets since 2022 when interest rates started to climb. That hurt the markets. 2022, 2023, stabilizing in 2024, and now these interest rate sensitive instruments are starting to perform quite well. So let's take a look at my ratings then. US large cap stocks, neutral, bullish in the long term, neutral on both time frames for the NASDAQ and small cap stocks. Canadian stocks, bullish on both time frames. Gold, bullish on both time frames. Oil, short term bearish, but neutral long term. US dollar, neutral on both time frames. Bitcoin, I'm still long term bearish, but it's a little bit better in the short term. And then finally on bonds, bullish on both time frames. All right, time for the trade of the week. I told you at the top of the video, I had a trade that made 5 times its risk. I want to explain what that means and why it's so important to trading. So let's jump in to this chart of SMX, which had a great move. I want to begin by describing why I was watching this stock. So in the pre-market on Friday, it was trading abnormally. It had made a strong gain and it gapped up on the open right there. That abnormal activity is what made me put it on my watch list. But then I have to watch the stock for an entry signal. And for me, there's 2 things I like to see. Number 1, either an abnormal price break from low volatility or the break of a pullback once the stock is trending strongly. If we look at this chart again, you will see that there's a little break right there, and you'll also notice that there's a pink and yellow dot. That pink and yellow dot is my own indicator. It's called an action candle, and it represents abnormal price and volume activity on that very short-term interval. That's a 1-minute chart. So that was the buy signal. It had been trading with low volatility very quietly, and then it came alive with abnormal price movement and abnormal volume. Now I have computers watching the entire market, and they ring a bell essentially when this sort of thing happens. And that was the entry price at 361. Now we always plan to lose on a trade. And so the yellow line represents our lower boundary of risk. And the difference between that is the risk of the trades. We call that risk. And then we calculate multiples of risk to the upside and use that for the selling strategy. So in this case, the buy is at 361 and the stop point is at 316. So it has 45 cents a share in risk. So if you bought 1,000 shares, the risk is $450. If that stock then moves up as it does, you can calculate the risk-reward ratio. And the way we do that is simply counting the green lines. So we have 1, 2, 3, 4, 5, 6, 7. So it went up as much as 7, but my sell signal was actually right here when it broke down from a falling top, breaking the upward trend line. And that was at 4 times risk, or perhaps 5 times risk on the rebound. So if you risked $100, the profit is $400 or $500. If the risk was $1,000, then the profit is $4,000 or $5,000. But what's key is watching stocks that have alpha, which means they're trading abnormally, something's happening with them, and then we watch for that action candle to break from low volatility, jump on very quickly, and enjoy the ride higher. If you'd like to learn more about how to do that sort of thing, please visit Stockscores.com. You can sign up for my free weekly newsletter there. Each week, I present trading tactics. I pick a couple stocks. It's all free. Just go to the homepage of Stockscores.com and you'll see the link to register at the website. Please make sure you're subscribed to the channel. About half of you are not, and I'd appreciate it if you were subscribed. It helps the channel grow. And if you like this video, click the like button. I'd appreciate that. Hope you've enjoyed this week's video, and as always, trade well.